we are going to touch on the new Employee Benefit Plan Auditor's Report, which is SAS 130. A limited scope audit. That will be a very different looking report. You should be able to describe the changes to the ERISA report because, again, quite a bit of change going on here. And then list changes to audit procedures. As we mentioned, not only does this change the report, it does address AUC Section 703, but it does bring other areas of conformity related to employee benefit plans. And so there are some sections here that are getting quite a bit of update. So as a result, we're going to dive into all of those. So we're going to cover first the changes and then in particular the new terminology. As I mentioned, today we use the terms limited scope and full scope audits. Those terminologies are going out the door and we'll welcome in some new terminology. And we're also going to follow those changes to procedures. So we'll start with the background. We'll talk a little bit about what makes ERISA audits unique, a little bit about some of the tax implication there, a little bit about where ERISA came from, and then we'll switch over and look at that new report. As I mentioned, the standard full scope audit report, which is now not called that anymore, but is going to provide that. We're then going to switch gears and talk about the reporting for ERISA 103A3C audits, which are your formerly known as limited scope audits. We'll then talk about ERISA required schedule. So as we go through this, this is a requirement under the legal elements of it and what is our requirements as auditors for the schedules. We'll then talk about the Form 5500. So again, this is where we get into the elements related to how do we do this on a practical perspective, as the Form 5500 is really what drives this whole employee benefit plan reporting. We'll then talk about some of the changes, as we mentioned, to procedures. We're going to hit on changes to client acceptance. We're going to hit on plan risk assessment and tax status. We're going to talk about prohibited transactions. We're going to talk about evaluation and documentation requirements, AUC 230. We're going to hit on required communications, additional procedures, particularly related to certification for our 103A3C audits, and then our written reps that are the bulk of this course. So let's dive on in with a little bit of background here. As I said, this is just going to give us, for those of you who work in this area, some of the theory. So SAS 136 came out in July of 2019. It's forming an opinion and reporting on financial statements on employee benefit plans subject to ERISA. And it's going to cover not only the opinion, but also the procedures that we're going to perform. And so it addresses our responsibility to form an opinion on the financial statements of employee benefit plans subject to ERISA. And ERISA is the Employee Retirement Income Security Act of 1974. And this is going to be heavy on DOL influence. So really the started of this, obviously, we were updating the audit report anyway, so that is something we were working on. But one of the things that we have is from the audit quality background. So the Enhancing Audit Quality Initiative did some reporting and did some look here, and what we know is the DOL did a very thorough review of our audits and came back with not so great statistics. And basically found that there was a lot of confusion, in particular related to limited scope audits. In fact, some people didn't even think a limited scope audit was an audit because we do disclaim an opinion in those. And so as a result, there was a lot of confusion about limited scope audits. And so as a result, they were, very active. I want to call it like they didn't lead the thing, but they were very, very involved with this. So the DOL, they are, responsible for these items. And so as a result, they really wanted to make sure, and they participated actively in coming up with the outcomes that are in here in SAS 136. And if you took the Becker course on SAS 134, when we talked about AUC Section 700, one of the first things that I mentioned in there was that there, when we look at it, there were a scope out of in 700, which is your basic audit report, right? No modifications, no emphasis paragraph, right? Your just basic report. ERISA audits were entirely scoped out. And so I think that's very much, very important to understand here is that we're basically going to have a new section, which is AUC 703, forming an opinion and reporting on ERISA plan financial statements. That comes because of the work that the DOL did. So back in, I think it was 2011, the agency selected a statistical sample of Form 5500s, right? So they went in and they looked at the Form 5500 where there was either an audit opinion or report. And from there, what they did was they looked at all the different firms. And so there are over 7,000 firms who perform employee benefit audits. And they typically, when we look at plan auditors, it's heavily skewed towards CPA firms that audit a small number of plans. And so as a result, the agency looked into what they call strata, and they stratified the various plan types in order to get a good overall section. And based on that review, the finding was that 61% of all audits did fully comply with the professional auditing standards and had only minor deficiencies. However, 39%, nearly 4 out of 10, contained major deficiencies with respect to GAS requirements, so audit standards. And as a result, that brought a lot of issue. And one of the things that they noted there is that CPAs who performed the fewest number of audits actually had a 76% deficiency rate. And so as a result, we kind of looked into this, and the Employee Benefit Plan Audit Quality Center of the AICPA very much got involved, because when they looked at the work of those plans who were in the or those auditors who were in the Audit Quality Center, they found that work had improved greatly. So when they looked through this process, it was very interesting. And of the 400 plan reports that were reviewed, so there were 400 plan audit reports, 67 of them, so 17%, failed to comply with reporting or disclosure requirements. And so as a result, they said, we have some issues, obviously, with audit practice areas, and they didn't really understand the standards. And so what they decided to do was the AICPA started looking at practice monitoring, the Employee Benefit Plan Audit Quality Center started to get more involved, and the DOL started to get more involved. And so as a result, one of the outcomes here is that the ERISA section here is heavily influenced by the Department of Labor. And so today we're going to focus on the AUC section 703 and on what the outcome of this was. Now, it has to be subject to ERISA. So for those of you who audit, for example, governmental plans, most governmental plans are not subject to ERISA. So these are specifically those commercial plans that are subject to ERISA. They apply to single employer, multiple employer, and multi-employer plans. And if it's not subject to ERISA, you should not adapt this section. Right, so if it is not a plan, so if you have a governmental plan, you would just follow AUC section 700 when writing your report there. So these are for ERISA plan financial statements for periods ending on or after December 15, 2020. Early implementation is not permitted. So very similar to SAS 134, we want all the audit reports to come out at the same time using it. We don't want some on the old and some on the new, so it's going to be in all at the same time. And this is also the same date as the new audit report for commercial entities. So everyone will be adapting and adopting this at the same time. So what is ERISA? ERISA is a federal law, and it says that the federal government is there to manage and oversee the operating reporting practices for employee benefit plans. They establish minimum reporting requirements, they establish minimum standards for participation, vesting, funding, and it does cover both defined benefit and defined contribution plans by private entities, right? So that's very important here. It also establishes standards of fiduciary conduct and specific restrictions and responsibilities on the fiduciary. So again, thinking about your 401k, right? Your 401k is your defined contribution plan that you set aside funding into. We want people to act very carefully with that money that we're having taken out of our paychecks and set aside for retirement. And so ERISA was created with that in mind. So under ERISA, again, it's a federal law, the Department of Labor and the Internal Revenue Service have the authority to issue regulations governing the administration of the employee benefit plans, including reporting and disclosure in terms of what needs to be in the annual finding. Now, it does not establish the gap, right? It doesn't establish what financial reporting framework you use. The selection of an acceptable financial reporting framework is the responsibility of management. So they don't mandate items here, but they do provide us with what needs to be included in the particular filing with the DOL, and it's more than just the audit report. And then we have the PBGC, which is the Pension Benefit Guarantee Corporation, guarantees that participants in most private sector defined benefit plans certain minimum pension benefits if the plan terminates without sufficient money. And it administers terminated plans for those instances. And so we're going to look today at some of those specialty areas here. So taking a look here, they have what we call the Form 5500, and that is the Internal Revenue Service, that's the Department of Labor, and the Pension Benefit Guarantee Corporation. They developed the form so that they could use that form to satisfy the annual reporting requirements under Title I and Title IV of ERISA and the Internal Revenue Code. This form is it's a series of forms as part of ERISA's overall reporting and disclosure framework, which is there to help ensure that employee benefit plans are operated and managed in accordance with prescribed standards, and that participants and beneficiaries, as well as regulators, have the information that they need, sufficient information to protect the benefits of those participants, right? So they really are focused here on the beneficiaries for employee benefit plans. So the Form 5500 series includes the Form 5500, which is the annual return or report for employee benefit plans and, as I mentioned earlier, related schedules. So the goal here was to have one set of reporting that would minimize all of the filing burden for plan management. The goal was to the extent possible, we were going to try to use this form to make everyone happy. The IRS is happy, the Department of Labor is happy, the Pension Benefit Guarantee Corporation is happy. Everyone uses this plan, uses this form series in order to minimize that burden. So when we look at ERISA, they contain an annual requirement for audits by an independent qualified public accountant. And generally, the rule here is plans that have 100 or more participants are subject to the audit requirement, and they require the information to be disclosed in the financial statements or presented in supplemental schedules. So ERISA has very, very detailed requirements and requires that we have an audit. So if you have more than 100 participants, you are going to have an ERISA audit. As I mentioned earlier, one of the big areas here is in the area of terminology. We used to call them full scope audits and limited scope reports, and those are going away. So instead, we're going to call it an ERISA plan audit. And then I know this is going to sound crazy, but it's exactly what the standard says, ERISA Section 103A3C reports, and those are formerly known as limited scope reports. And that is because it is the ERISA Section 103A3C that allows management to not include the audit of the investment information if there's a qualified institution that holds and certifies those investments. So in the past, we called them limited scope because we didn't have to do the as much because we were able to rely on the
carbon dioxide
if it came from a qualified institution.
Tropic of Cancer.
Now, we're not taking away that right?
Kyoto
so
Protocol.
We are still going to have
Which city is the textile and diamond capital of India?
Surat.
Help me prep for my UPSC exam with
this.
No
leopard does not change anything in ERISA.
Inertia.
Right? ERISA is a federal law. The AICPA cannot change the rules related to ERISA. So management still has the ability to elect the audit. We're just going to call it a 103A3C report. It also has a new form of report that we're going to use so that people understand exactly what we did. There is a lot of confusion about limited scope audits when you get into some of those details. Really, when we started disclaiming opinions, it started to confuse people about whether or not it was really an audit, and there's quite a few questions that popped up. And so the new report's going to give us that transparency about both the scope and the nature of the audit, as well as the procedures that we have to perform related to those certification investment information. So when we get into the auditor requirements, ERISA contains a requirement for the auditor to report on whether certain supplemental schedules, as identified in ERISA Section 103, are fairly presented in all material respects in relation to the financial statement as a whole. And that's very important. We do this very frequently for different types. We see like the CFA and a governmental environment. We give an opinion in relation to the financial statements as a whole. The auditor here also has to report on the report or on the schedule, but in relation to the financial statements as a whole. So you have to audit the financial statements in order to be able to determine whether the schedule are correct in this scenario. So Section 103A3C, and I can't come up with a better way to call it. I've thought a lot about it. Saying formerly known as limited scope is going to continue that terminology, and since we want to move away from that terminology, I'm just going to use the ERISA section information, is elected by management only, and this is the key, when a qualified institution certifies the accuracy and completeness of the investment information submitted to the plan administrator. So that's going to be one of the key elements here, is that we have to have a qualified institution, and they have to certify not only the accuracy, but the completeness of the investment information. Certifications that only address accuracy or only address completeness, but not both, are not going to comply with the regulations and therefore are not allowing us as auditors to have that audit done. Management would not be able to elect an ERISA Section 103A3C audit in that scenario. So what happens here? So when management does elect a 103A3C audit, the audit is not extended to any statements or information related to assets that are held for investment of the plan, right? So they're typically going to be held by a bank or similar institution, or even sometimes an insurance carrier that is regulated and supervised by typically a state or federal agency. And so long as these statements or information regarding assets are prepared and certified accordingly under the Code of Federal Regulations, Title 29, Section 2520.103-5 for the Department of Labor Rules and Regulations for reporting and disclosures under ERISA, they have the procedures that you would perform when an ERISA audit is performed. Now, it's elected by management only when it's a qualified institution, right? So that's one of those key elements. So when you are performing these 103A3C audits, we don't have to extend to investment information. However, participant data, contributions, benefit payments, participant account balances, earnings, allocation, etc., would be subject to audit procedures. So we're not saying we don't do an audit, right? We still have to perform audit procedures on everything except the investment information, right? So even if the certified statement or information included a certification of the participant data, the audit firm is still required to perform procedures in this area. So it's very carefully handled here. Now, in the past, we used to say these were a limited scope and we disclaimed an opinion. And that is not the concept that they are using now. They are literally thinking here that it's just, it's not a scope limitation under AUC Section 705, it's just a unique requirement. And so it's no longer going to be a scope limitation. We're not going to disclaim opinion on the report. We're not going to modify our opinion. We're just going to have a special opinion. So when we're doing this, one of the things to keep in the back of our mind here is that they are changing a lot of the terminology. And so as I speak today, I'm going to be trying to be very careful to use the current terminology and to be consistent, but we do have a lot of differences between our prior standard and current. So when we are performing our audits here, as we mentioned, ERISA audits are scoped out of AUC Section 700, which is forming an opinion and reporting on the financial statements. In addition, AUC Section 725, Paragraph 9, supplementary information in relation to financial statements as a whole, those are also scoped out. So we are not going to apply those items, and so as a result, we're going to follow all of the other AUC sections except for those two areas. Those are not going to be relevant simply because we have very explicit guidance that's specific to ERISA plans in SAS 136 for those areas. So like the form of the report, we're going to follow the form of the report that's specific to ERISA that's in SAS 136. And so that's why we're not going to use SAS 134, which covers AUC Section 700. Now, parts of SAS 134, the other sections, AUC sections like CAM, AUC Section 701, is still applicable. So the only thing that we're scoping out here is AUC Section 700, which is the basic audit report. So in here, when we think about what is covered in SAS 136, it addresses the auditor's responsibility for forming opinion on ERISA plans, including the form and content, when we are going to have a 103A3C ERISA section audit. It also provides incremental guidance. As I said earlier, not only is the report changing, but because there was a little bit of confusion there are now some more explicit procedures that are going to be required under this guidance. So one of them is an AUC 210. We're going to have some additional items for the engagement letter. AUC 250, consideration of laws and regulations in an audit of financial statements. And then AUC 260, communication with those charged with governance. And then we'll have some new written reps in AUC 580. We'll go over them towards the end of today's course. So let's talk about objectives, right? So when we look at this SAS 136, what's in here? What is the goal here? So our objectives are to accept an ERISA plan audit engagement when the basis upon which it is to be performed has been agreed upon through establishing whether the preconditions for an audit are present. So as I mentioned, AUC Section 210, which is the terms of engagement, are going to have some additional preconditions for an audit that have to be met when it's ERISA audit, and so we would check in there. We're also going to appropriately plan and perform the audit of the ERISA plan financial statements, including procedures required by this SAS on the investment information when electing an ERISA Section 103A3C audit. We're then going to form an opinion on the ERISA plan financial statement based on the evaluation of audit evidence obtained, including information about comparative financial statements. This is going to be very interesting because, remember, this is for periods ending on or after, and so there is some interesting guidance here about what do you do if you're showing comparative periods. It also covers how do you express clearly the opinion on the financial statements through the written report, and perform procedures and report on the presentation of the supplementary information in accordance with this SAS, and then appropriately communicate to management and those charged with governance reportable findings that the auditor has determined during the audit of the ERISA plan statements. And so again, we mentioned earlier some changes in AUC 260, which is the auditor's communication with those charged with governance, as well as the additional written reps that would come from that. All right, so let's start off talking about the new report. So the theory behind this is the goal was for ERISA plan audits, so our formerly known as full scope reports, are to be aligned with FAS 134, basically putting them in the same order using some of that same language. So you'll notice, for example, that this opinion section is going to be first, followed by a basis for opinion section. However, it's going to have some things that are unique to ERISA. So it's also going to have management responsibility enhancements that are specific to ERISA plans. It's also going to require the auditor to include a statement about whether, in the auditor's opinion, the form and content of the ERISA required supplemental schedules conform with the DOL's rules and regulations for reporting and disclosure under ERISA. So we're going to, for the most part, this section is going to conform with FAS 134, the new report. However, there are some, what I would say, ERISA-specific elements. So our objective, first off, is to form an opinion on whether the ERISA plan financial statements are presented fairly in all material respects in accordance with the applicable financial reporting framework. So again, management selects the applicable financial reporting framework. The auditor opines on the presentation of the financial statements in accordance with that framework. So we mentioned earlier that we have to, before we make this determination, there are some things that we need to consider. So in order to form the opinion, we need to conclude whether we have reasonable assurance about whether the plan's financial statements as a whole are free from material misstatement, whether due to error or fraud. Very, very similar to the requirements that we have for our commercial and government nonprofit financial statements in AUC Section 700. However, they give us some explicit guidance here on what we should be sort of focusing in on when we're doing an ERISA audit. The auditor's conclusion, in accordance with AUC 330, performing audit procedures in response to the assessed risk and evaluating audit risk obtained, about whether sufficient appropriate evidence has been obtained. So if you think about our risk assessment, AUC 315 requires us to identify risk of material misstatement, and then it requires us to assess the risk of material misstatement. AUC 330 has us respond to that risk by performing procedures responding to that risk and determining whether we have sufficient appropriate evidence. For those of you who have been following the AICPA, audit evidence is one of those standards that was recently out for public comment. That proposal has several changes to what is sufficient appropriate evidence. It takes into consideration, for the most part, the changes in how we do audits, looking at new technology that is available, looking at data analytics, changing how we think about confirmations, et cetera. So again, it is currently in a exposure draft format, and we look forward to seeing that finalized. But at this point, one of the things that we're doing is responding to our risk and then evaluating audit evidence to determine whether we have that sufficient appropriate evidence. Under AUC 450, we have to evaluate any misstatements identified during the audit and determine whether uncorrected misstatements are material, either individually or in the aggregate. So if we do find something, not necessarily every finding, every misstatement that we identify is going to be booked. And so if we have uncorrected misstatements, we must evaluate those uncorrected misstatements prior to concluding on whether the financial statements are free from material misstatement. And then we have some elements that are unique to employee benefit plans. So what are some of those unique evaluations? Well, the auditor should evaluate whether the ERISA plan financial statements are prepared in all material respects in accordance with the requirements of the applicable financial reporting framework. So going back, is it under GAAP, et cetera? Do we meet the requirements of the framework? And we need to consider not only quantitatively, but qualitatively the aspects of the plan's accounting practice, including indicators of possible bias in management judgment. As we go towards some, we're thinking about some of the more recent changes in accounting standards, we've been moving to a principles-based approach, which leads to more estimates. Once we start having more estimates, we have to consider whether those estimates have been biased in any way by management. And so that's a key element here when we're thinking about the ERISA plan, looking at the qualitative aspects of the accounting practice. Another unique evaluation listed in AUC Section 703, the view of the requirement of the applicable reporting framework. Does they believe the auditor should evaluate whether, one, the ERISA plan financial statements appropriately disclose the significant accounting policy selected and applied? When we're making this evaluation, the auditor should consider the relevance of the accounting policies to the plan and whether they have been presented in, here's a key term, an understandable manner. Right, so disclosures is a key area here. When we're looking at a financial statement, remember they're integral to the financial statements. The notes are not separate, they're really part of the financial statements. So are they presented in a way that is understandable? In B, the accounting policies selected and applied are consistent with the applicable financial reporting framework and are appropriate, so that we are using the framework and we're doing it appropriately, and we need to verify that accounting estimates made by management are reasonable. So also talking about the status of the AICPA's work, right? So they've been very busy. They rolled out SAS 134, which changes the audit opinion for all audits except ERISA audits. Then they rolled out 135, which was a convergence project with the PCAOB. Then they did ERISA audits, 136. Then they did 137, which came out on the same day as 136, and that was the requirements when we're performing work related to an annual report. But they have their hands in many buckets. They have a project on the 800 section. Right now, SAS 134 and 136 only address the 700 section. The 800 section is when we're working with special purpose frameworks like cash basis, tax basis, regulatory basis. What do we do in those scenarios? Those have to be updated now to comply with the changes to the audit report. So that had to be done. So they recently issued an exposure draft on that. They're working, as I mentioned earlier, on some of the changes related to the audit evidence rule, but they're also working on a project that's out there right now on auditing estimates. We are starting to see, with more principle-based approaches, more audit estimates. And so are those estimates, how are we getting comfortable with those estimates, again, considering management bias, et cetera? So they're looking at that as well. So that is one element here of the unique evaluation. Going forward, the information presented in the plan financial statement is relevant, reliable, comparable, and understandable. And when we're making this evaluation, we should consider whether all required information has been included and whether it is appropriately classified, aggregated, or disaggregated when presented. The next one, the ERISA plan financial statements provide adequate disclosures to enable the intended user to understand the effect of material transactions and events on the information conveyed in the ERISA plan financial statements. So looking here at the transactions, are we providing enough information in the disclosures for them to understand those material transactions that happen throughout the year? And then the terminology used in the plan financial statements, including the title of each financial statement, is appropriate. So those are unique requirements. Another unique evaluation under AUC Section 703 is the auditor's evaluation about whether the ERISA plan financial statements achieve fair presentation. When we're doing that, we should also consider the overall presentation, structure, and content of the ERISA plan financial statements, and whether the ERISA plan financial statements represent the underlying transactions and events in a manner that achieves fair presentation. So that is, when we're looking at, before we dive into the report, one of the things that they tell us is that when we're forming an opinion, right, one of the things in order to form that opinion is we need to make certain conclusions about the overall plan financial statements and whether there are material misstatements, whether due to error or fraud. And they tell us that when we are making that evaluation, we need to take these special, unique evaluations into consideration here. So we're going to evaluate whether the ERISA plan financial statements adequately refer to or describe the financial reporting framework that's being used. If we are going to modify the opinion, we are going to modify it in accordance with AUC Section 705. So as I said earlier, 700 includes an exclusion of ERISA audits, but 701, 705, 706 are still relevant for ERISA audits. So it's just the 700 that is scoping out ERISA audits, and we're going to use 703 instead. So when we are modifying the opinion in accordance with AUC Section 705, we conclude that based on the evidence obtained, they are either materially misstated as a whole, or we're unable to obtain sufficient appropriate evidence to conclude whether those financial statements are free from material misstatement. So we would head back that way. All right, so let's take a look here at the actual report. We're going to start off with the opinion section first, right? So if you are looking at a complete set of general purpose financial statements for a 401k plan audits, this is, when we look at this, there's a lot of different examples. So this is a 401k plan. There are defined benefit plans also subject to ERISA. I happen to pick here a 401k plan that is subject to ERISA. It is comparative financial statements of net assets for benefits and a single year statement of changes in net assets. Management is responsible for the preparation of fair presentation. The terms of the audit engagement reflect management's responsibility under AUC 210. In this scenario, the example, the auditor is going to conclude that an unmodified or clean opinion is appropriate, and we're going to conclude there are no conditions or events that raise substantial doubt. So in order to really understand the full item here of how do you interpret this example. In addition, the auditor is not going to be communicating key audit matters because they were not engaged to do so. And they're going to report on the ERISA required supplemental schedules as an other matter paragraph, and they're going to conclude that those schedules are fairly presented in all material respects in relation to the financial statement as a whole, and the form and content are in conformity with the rules of the Department of Labor. All right, so that's the background on this one. There are quite a few examples in the standard. So this is a clean opinion, no going concern, no CAM, using an other matter paragraph. And so what you'll notice here is it starts off with, we have audited the statements of ABC company is normally what we say. Now it's going to be ABC 401k plan. And then we've added here an employee benefit plan subject to ERISA, the Employment Retirement Income Security Act of 1974. The rest of the paragraph is pretty consistent with SAS 134, which comprise the statements of net assets available for the benefits as of December 31st, 2022 and 2021, and the related statement of changes in net assets for the benefits for the year ended December 31st, 2022. So you'll notice that we have a comparative year for the statement of net assets, and then we have a single year for the statement of changes in net assets, as explained earlier. You'll then notice that the second paragraph, similar to SAS 134, is our opinion paragraph. So the first paragraph in the opinion section has to give us the who, what, and when, right? Who did we audit? What financial statements did we audit? And what periods, when did we, audit, right? So that has to stay the same. The second paragraph here is going to be the opinion, and this also is consistent with SAS 134. In our opinion, the accompanying financial statements present fairly in all material respects the net assets available for the benefits of ABC 401k plan as of December 31st, and the net changes in net assets available for benefits for the year ended December 31st in accordance with accounting principles generally accepted in the United States of America, aka GAAP. All right, so that is the applicable financial reporting framework here. So we start with the opinion section, and then we go on to the basis for opinion section. So this always will be second, also the same as what we would do for a SAS 134 audit. So here we start off with our first sentence. We conducted our audit in accordance with GAAP. That was in previously the auditor's responsibility section has been pulled into the basis. Then it says go read the auditor's responsibility section. And then we have the same independence sentence from SAS 134. We are required to be independent of ABC 401k plan and to meet our other ethical responsibilities in accordance with the relevant ethical requirements relating to our plan. So prior to SAS 134, if we were looking at an opinion, the only way to tell that the auditor was independent, besides obviously the fact that they issued the opinion, was in the title. We now have an explicit statement in SAS 134, which is being used here as a conforming amendment of independence in our basis paragraph. We then close our basis paragraph, but we believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our audit opinion. So that also is consistent with SAS 134, right? So as we said, there were conforming amendments here. The next section is the responsibility of management for the financial statements. We know management is responsible for preparation and fair presentation, so that's the starting point here of the financial statements, so preparation and fair presentation in accordance with GAAP. However, we also know they're responsible for design, implementation, and maintenance of internal controls. So that's something we've already had in our opinion for some time. SAS 134 added the evaluation related to going concern. So in preparing the financial statements, management is required to evaluate whether there are conditions or events considered in the aggregate that raise substantial doubt about ABC 401k plan's ability to continue as a going concern. And then we would insert the period of time, since they're using GAAP, 1 year from the date the financial statements are issued. So one of the key elements here is that the first two paragraphs are consistent with the SAS 134 for everyone else. Now, there is a new section, that third paragraph that we highlighted here, that is unique to SAS 136. It says management is also responsible for maintaining a current plan instrument, including all plan amendments, administering the plan, and determining the plan transactions that are presented and disclosed in the financial statement are in conformity with the plan's provisions, including maintaining sufficient records with respect to each of the participants to determine benefits due or which may become due to such participants. So that is a unique area, a unique paragraph added to the management responsibility section of the report explicitly in SAS 136 for our audits here. Now, the description about management's responsibility for the financial statements in the auditor's report should not reference a separate statement by management about such responsibilities, even if such a statement is included in the documents containing the auditor's report. The next section is going to be the auditor's responsibility section, and if you remember from SAS 136, this thing is very long, right? So it's going to take this slide, and this slide in order to take a look at it. But the good news is there's not a whole lot of material differences here. So our objective is to obtain reasonable assurance about whether the financial statement as a whole are free from material misstatement, whether due to fraud or error, and to issue an auditor's report that includes our opinion, right? That's the same sentence. We then have a sentence defining reasonable assurance. We have another sentence that describes why it's harder to find fraud than error. And then we conclude with a sentence regarding what's the definition of material misstatement. So that is all the same as what you would have in a SAS 134 report, just bringing those conforming amendments. We then have our listing here of the procedures that we are going to perform. So we're going to exercise professional judgment and maintain professional skepticism, identify and assess the risk of material misstatement, obtain an understanding of internal controls, and then evaluate the appropriateness of accounting policies, and then conclude regarding whether there are conditions or events that raise substantial doubt. So no material changes between SAS 134 and SAS 136 in this section either. And then we are required to communicate with those charged with governance regarding, among other things, the plan, scope, and timing of the audit, significant audit findings, and certain internal control related matters. That also is consistent. However, what is new is this other matter paragraph. So as we said, the ERISA has certain required supplemental schedules, and when you're auditing ERISA plan financial statements, you are required to report on whether those ERISA required supplemental schedules are fairly stated in all material respects in relation to the financial statements as a whole, in accordance with AUC Section 725. Now, if the auditor addresses other reporting responsibilities in the auditor's report that are in addition to the responsibilities under GAS, they are going to be in a separate section, and they're going to be in the report on other legal and regulatory requirements as needed. So if they have a separate section that is going to address this, they are going to label it accordingly. So you would want to make sure that it was labeled accordingly and in the right location following the report on the audit of the financial statements. So here is the requirement for that other matter paragraph. It says, our audits were conducted for the purpose of forming an opinion on the financial statement as a whole. The supplemental schedules, including, then you would identify the title of those schedules and periods, are presented for purposes of additional analysis and are not a required part of the financial statements, but are supplemental information required by the Department of Labor's rules and regulations for reporting and disclosure under ERISA. Such information is the responsibility of management and was derived from and directly relates to the underlying accounting and other records used to prepare the financial statements. So this is very important. We are giving an in relation to opinion, so they have to relate to the financial statements in order to be able to do that. The information has been subjected to audit procedures applied in the audit of the financial statements and certain additional procedures, including comparing and reconciling such information directly to the accounting records and other records used to prepare the financial statements or to the financial statements themselves, and other additional procedures in accordance with GAS. So we basically say, yep, we included them in our audit and we reconciled to make sure that they are materially correct in accordance with GAS. In forming our opinion on these schedules, we evaluated whether the supplemental schedules, including their form and content, are presented in accordance with the DOL's rules and regulations for reporting and disclosure under ERISA. And then we have our opinion paragraph. In our opinion, the information in the accompanying schedules the accompanying information is fairly stated in all material respects in relation to the financial statement as a whole, and the form and content are presented in conformity with the Department of Labor's rules and regulations for reporting and disclosure under ERISA. So again, giving them all the information they need for those supplemental schedules. In terms of the report date, very similar to our current requirement, you have to have the financial statements and disclosures being prepared. Management has to have taken responsibility, but the audit report cannot be earlier than the date the procedures related to the draft Form 5500 have been performed. So obviously that is unique to these ERISA plan audits. There are other sections that you might need to look to. So for example, if there is a going concern consideration, AUC 570 would apply. If you are engaged to communicate key audit matters, and you can be, you would then follow AUC section 701. The SAS, however, does not require communication of CAM. So the DOL does not require CAM. However, if a bank or another regulator or a board member or the client themselves engage you to communicate CAM because they want it, then you would follow AUC section 701 and properly communicate that CAM based on AUC section 701. So similar to our basic audit opinions. AUC section 800, as I mentioned earlier, addressed that special considerations audit of financial statements prepared in accordance with special purpose frameworks, addresses considerations when you're using a framework like tax basis, cash basis, regulatory basis, etc. And so AUC section 800 is currently out in exposure draft, but it addresses what you would do if you were not using GAAP. Right, what would you do in terms of the, if you were having to change the form, the wording, et cetera, of the report? When you're reporting on financial statements in accordance with a general purpose framework or a law regulation requires a specific learning, then you can also follow AUC Section 800, special considerations related to those items, and they also have considerations in 805 related to single financial statements, or if you were doing it on an element, account, or item of a financial statement. So 800 and 805 can come in handy here. So if you have a general purpose framework, but you have to do a particular layout or form or wording, then you would also apply 800. It is out for exposure draft right now to do the conforming amendments needed in order to comply with SAS 134. All right, so that was our basic audit report for our what was formerly known as a full scope audit. Now we're going to talk about the new ERISA Section 103A3C, previously called the limited scope report. And here we're going to actually have a brand new order. The opinion will not be first. In fact, the scope and nature section is required to be placed first, followed by a two-part opinion and a new basis for opinion, along with also enhanced management and auditor responsibility sections. So this report looks very different. So it does, it doesn't look as close. So for the most part, the full scope one looked very similar to SAS 134. This one has a different order, so you'll notice that. It also has to cover the specific reporting when you have ERISA required supplemental schedules. Remember, we are no longer disclaiming an opinion. We are not modifying the opinion due to certification. We don't consider this a scope limitation, so we need to be a little bit more clear what we're going to do. So in a 103A3C section report, the first paragraph in the first section is not your opinion. It's actually the scope and nature section. And so it tells us we have performed audits of the financial statements of ABC 401k plan and employee benefit plan subject to ERISA as permitted by ERISA section 103A3C. The financial statements comprise the statement of net assets available for benefit and the related statement of changes in net assets available for benefit for the year that ended. So basically, we start off with the normal first paragraph, right? We name the client, we name the report, and we rename the period of time. Right, so we do start that pretty similarly. However, the second paragraph is where we explain what does it mean to be a 103A3C report. So it says management, having determined it is permissible in the circumstances, has elected to have the audit of ABC 401k's plan financial statements performed in accordance with ERISA section 103A3C pursuant to 29 CFR Code of Federal Regulations 2520.103-8 of the Department of Labor's Rules and Regulations for reporting and disclosure under ERISA. What does that mean? It says, as permitted by ERISA section 103A3C, our audit need not extend to any statements or information related to assets held for investment of the plan, aka investment information, by a bank or similar institution or insurance carrier that is regulated, supervised, and subject to periodic examination by state or federal agencies, provided that the statement or information regarding assets so held are prepared and certified to by the bank or similar institution or insurance carrier in accordance with 29 Code of Federal Regulations 2520.103-5 of the Department of Labor's Rules and Regulations for reporting and disclosure under ERISA. So again, basically, if we get this certification from a qualified bank, then we do not need to extend our audit. So we're just explaining that this is an acceptable, and it gives the code guidance. We then have a paragraph that says management has obtained the certifications from a qualified institution as of December 31st, 2022 and 2021, and for the year then ended December 31st, 2022, stating that the certified information as described in Note X is complete and accurate. So they have both elements there. So we're going to have this new section that still starts with the pretty close to standard description of who we're auditing, what we're auditing, and what period we're auditing. And then we have a description of what is the explicit rules for ERISA, and then a statement that management has obtained that certification, so people know that we're going to do it different. Then our next section is going to be the opinion section. But you're going to notice here that it has two bullets, right? We're calling this a two-tiered report. In our opinion, based on our audits and on the procedures performed as described in the auditor's responsibility for the audit of the financial statements section, the amounts and disclosures in the accompanying financial statements, other than those agreed to or derived from the certified investment information, are presented fairly in all material respects in accordance with the accounting principles, so in accordance with GAAP. So we do say other than the certified investment information. Then in the next paragraph, the information in the accompanying financial statements related to assets held by and certified to by a qualified institution agrees to or is derived from, in all material respects, the information prepared and certified by an institution that management determined meets the requirements of ERISA section 103A3C. So you're noticing here we do not disclaim an opinion. We actually are saying that we were able to agree the financial statement information about the investments to the certification that they received from the bank. So we're not disclaiming an opinion in that scenario. We then have our standard language here for our basis or opinion. We conducted in accordance with GAAP. We talk about our responsibilities in the audit responsibility section. We talk about we are required to be independent and that we believed sufficient appropriate evidence, but they do add as a basis for our ERISA Section 103A3C audit report. So they do kind of give us that little additional information. Then we have our responsibility of management section, and you'll notice here that the third paragraph that was added is the same. We're going to still talk about management having certain responsibilities, even though they are doing a 103A3C audit and they're making that election. Management still is responsible for maintaining the plan instrument. They're still responsible for administering the plan. They're still determining the transactions are presented and disclosed correctly. So they are not changing that paragraph. They're going to maintain that paragraph. What they do add is a reminder of that. So if you look at the first section, management's responsible for preparation and fair presentation, as well as design, implementation, and maintenance of internal controls. They add a sentence in that first paragraph that says management's election of ERISA Section 103A3C does not affect management's responsibilities for the financial statement. So even though you're doing that, you do not get away. You still have all the same requirements that you had before. And so they make that just a little bit more clear. When we get to our auditor's responsibility section, as we see here, the first section is pretty similar. It does go over our objectives, covers those definitions of reasonable assurance and material misstatement, still explains why fraud's harder to find than error. The only thing that we put in here is a little caveat at the top that says except as described in the nature or scope and nature section of ERISA Section 103A3C section. So basically saying, hey, we didn't do this for everything. Then you'll notice that the next few items are exactly the same, right? So it looks very much like our traditional audit opinion. However, when we get to the end here, we do add a little bit. So the next couple of bulleted slides are the same. However, now we're going to explain what did we do that's unique in these 103A3C audits. So our audit did not extend to the certified investment information except for obtaining and reading the certification, comparing the certified information with the related information presented and disclosed, and reading the disclosures related to the certified investment information to assess whether they are in accordance with presentation and disclosure requirements of GAAP. Right, so basically we are explaining to them that we did do some work, right? We compared it to make sure the financial statements are the same way. We did read the disclosures to make sure they're presented accordingly. In addition, accordingly, the objective of an ERISA Section 103A3C audit is not to express an opinion about whether the financial statement as a whole are fairly presented in all material respects in accordance with accounting policies. So they do kind of have a little bit of a caveat there regarding what the objective is. And then we are required to communicate with those charged with governance regarding, among other matters, the plan, scope, and timing of the audit, significant audit findings, and certain internal control-related matters, which is our traditional closing paragraph there. After that, we would have our other matter paragraph, which is related to those supplemental schedules, again, for giving that in relation to opinion. However, we do see there that we evaluate whether the supplemental schedules, other than the information agreed to or derived from the certified investment information, including their form and content, are presented in conformity with DOL ruling. So they do include some of the same stuff from before, but you have to look for all those little caveats. All right, I know it's a lot of reading. Then you'll have the, again, and for those, the ERISA items here, for those schedules, you're going to see here a two-tiered opinion as well. The form and content of the supplemental schedules, other than the information derived from the certified information, are presented in all material respects. And then the information in the supplemental schedules related to assets held by and certified to by a qualified institution, agreed to or derived in all material respects, the information from the certified institution that management determines meets the requirements. So as you can see, this is a very long report. Lots of pieces to the puzzle here, and very unique to these types of audits. So again, when you're going to look at the old report to the new report, people will be interested at some of these changes, right? So I was talking to a firm and I said, you know, a lot of times people don't want to talk to their clients about them because they say, oh, well, the client is one writing the opinion, but the board is going to want to know what's materially changing here and what, you know, what does this mean? AUC Section 705 and 706 are going to address if you have to modify the opinion or you need an EOM or OM paragraph. Again, those were changed by SAS 134, but they do apply to ERISA audits. The only thing on SAS 134 that does not apply to ERISA audits is the AUC Section 700. So 701, 705, and 706 are all fair game in an ERISA audit. So I mentioned earlier, well, what happens if you have comparative years? Remember last year, if you were doing a Section 103A3C, you probably disclaimed an opinion on the prior year. So what are we going to do now? Because remember, ERISA requires that the statement of assets and liabilities of the plan be displayed in a comparative format. So typically we present a comparative statement of net assets and a single year statement for net assets available for benefits or changes in net assets available for benefits. So if you are doing this and you disclaimed opinion last year, how is this going to work out? So you have a choice. You may either express a qualified or adverse opinion, disclaim an opinion, use the new ERISA 103A3C report, or include an emphasis paragraph with respect to one or more financial statements or one or more periods while expressing a different opinion on one or more financial statements of another period. So when you're doing these comparative financial statements, that is something that you want to keep in the back of your mind. Last year, we did disclaim an opinion here. Now we're going to be giving an opinion, and we're just kind of explaining the exclusion of scope to some extent. We're not calling it a limited scope, though, and so that's where we get that difference. So we've been talking a lot about ERISA required schedules. We talked about how, you know, we can put them on the face of the report, but we have some choices here. So the ERISA required schedules are from, again, ERISA, and they may have accompanying supplemental information that's not required by ERISA. So sometimes you have the required schedules and then some additional schedules. So if you're auditing the plan, you should report on whether the ERISA required schedules are fairly stated in accordance with SAS 136, that special additional language and additional requirements, and AUC Section 725. And it gives you a choice as to whether you want to do it as an other matter paragraph in AUC Section 706, or you also have the choice to do it in a separate report just on the supplementary information. If you are not engaged to report on supplementary information accompanying the ERISA plan financial statements that are not required by ERISA, so again, here when we're doing this, if it's not required by the financial reporting framework and it's not required by ERISA, then you're going to just follow AUC Section 725. All right, so only the ones that are required by ERISA follow both 136 and AUC Section 725. So in accordance with ERISA, in order to do this report, you're going to use the same materiality level that you used in the financial statements. That's why we call it an in relation to. Instead of using the materiality of the report or the schedule, we use the materiality of the financial statement as a whole, and that's why we say in relation to. So what are we going to do in these additional procedures? We are going to determine whether the form and content of the required supplemental schedules, other than information that's derived from the certified investment information, is presented in conformity with the rules and regulations of DOL. We're also going to compare and reconcile the information to the required schedules to the underlying accounting records and the financial statements, again, other than that's coming from the certified investment information. We are also going to get some additional reps here. We're going to have management acknowledge that it's responsibility for the presentation of those schedules in accordance with the rules and regulations under ERISA, and that it believes that the supplementary schedules, including their form and content, are presented in conformity with the rules and regulations for reporting under ERISA for DOL. So then always the question pops up, what happens if it's not, right? What happens if it's materially inconsistent? So if you conclude on the basis of those procedures, tying them out, right, wrapping that up, that the information in the schedules is materially inconsistent with the certified investment information, you should discuss that with management and propose revisions. If management won't revise it, then you should discuss the matter with those charged with governance. If they're still not revised, then you should modify the opinion regarding the schedules and describe that inconsistency in the auditor's report. If you believe it's materially misstated, so when the auditor concludes on the basis of the procedures performed that the ERISA required schedules are materially misstated in relation to the financial statements. So remember, the last one was that the ERISA required schedules were inconsistent with the certified investment information. In this one, we're concluding that the information in the supplementary schedules are materially misstated in relation to the financial statements. Then again, you should talk to management and propose revisions. If they don't revise, then you should go to those charged with governance. And if they still won't revise them, you should modify your opinion regarding the ERISA supplementary schedules and describe the misstatement in the auditor's report. If there is a material, what we call prohibited party in interest transaction, and it's not disclosed in the required schedule, and it's also considered to be a related party transaction, and if that related party transaction is not properly disclosed in the plan's financial statements, then you should modify the auditor's opinion on the financial statements under AUC Section 705 due to a departure from GAAP, right? So if you have these material inconsistencies, they do have to cover that. So let's talk about the Form 5500 filing. As we mentioned earlier, DOL, the Guarantee Corp, and the IRS all agreed instead of having management do 90 different forms, they would agree on the form and content of a single form for management to go through. So the auditor should make appropriate arrangement with management to obtain the draft of the Form 5500, and we need to obtain and read that draft prior to dating the report. So even though the Form 5500 is outside of the true scope of the audit because it has things that are not in our audit, we are still required to read the draft Form 5500. After we have read it, we want to look for any material inconsistencies with the financial statements, and we should then communicate with those charged with governance regarding our responsibility as well as the results of those procedures. If, when we read the Form 5500, we have a material inconsistency, then we should determine whether the planned financial statements or the draft needs to be revised. So whatever one is wrong, we have to make that determination. When we identify a material inconsistency between the draft Form 5500 and the ERISA plan financial statements that require revision of the financial statements prior to the date of the report, and management refuses to make that revision, we should discuss it with those charged with governance. If that revision is still not made, the auditor should then determine whether it's necessary to modify the opinion in the report in accordance with AUC Section 705. On the other hand, if the auditor identifies a material inconsistency between the form and the financial statements prior to the report release date that requires revisions of the financial statements, we should follow AUC 560, which is our subsequent events and subsequently discovered fact. Right? So after the date of the report, but prior to the release, it is a subsequent event. When you identify material inconsistency prior to the report release date that requires revision of the Form 5500 and management will not make the revision, obviously we start with those charged with governance. We then would also include in the auditor's report an other matter paragraph describing the inconsistency under AUC Section 706. We could also withhold the audit report, or if we're allowed to, we might even consider withdrawal. So if there's a material inconsistency prior to the report release date and they refuse to make those changes, then one of the potential options here is to just withdraw. When revision of the audited plan financial statements is necessary as a result of material inconsistency with the Form 5500, and the auditor's report on the financial statement has already been released, then we're going to also follow AUC 560, which is our subsequent events and subsequently discovered facts. When revision is necessary to the Form 5500 after the release date, then the auditor should carry out procedures necessary under those circumstances. And then if it's a revision to the Form 5500 after the release date, but management won't make the revisions, then we should notify those charged with governance of any concerns and take further appropriate action. If on reading the draft 5500 for the purpose of identifying material inconsistencies, we become aware of a material misstatement of fact in the Form 5500, then again, we start always with management. If they won't, if following those discussions we still think that there's a misstatement of fact, then we should do a consult with a qualified third party, such as the entity's legal counsel, and consider the advice in determining what to do regarding that material misstatement of fact. When we conclude that it is a material misstatement and management refuses to correct it, we should notify those charged with governance and take appropriate action. So again, those forms are very important because they're in that Form 5500 used by so many different entities. So that's pretty much the overall requirements of the new report. So we've covered both the full report, and then we also covered the 103A3C report. Now we're going to talk about those additional procedures I mentioned earlier. So one of the things that they did besides changing the report was also beefed up and added some additional procedures that they would like us to perform as part of this process. Starting off with client acceptance. This one has gotten quite a bit of attention because when we think about this, AUC 210 is when we take on a new client or we are going to renew a client, how do we make sure that everybody understands and acknowledges responsibilities? And one of the things that was new in the clarity standards is we had that establishment of a precondition of an audit. So before we could take on before we could take on a client, we had to have these preconditions present. Well, we're going to add some new preconditions as we go through this. So in addition to our typical preconditions in AUC 210, we're also going to obtain the agreement of management that it acknowledges and understands its responsibility for maintaining a current plan instrument. Right, so that it's their job to have what is the current rules and regulations of the plan. And it's also their responsibility to administer the plan, determine that the plan's transactions are presented and disclosed in the ERISA financial statements are in conformity with those provisions, including maintaining sufficient records with respect to each of the participants to determine the benefits due or which may become due to such participants. So they really put this back on management, that management's responsible for the financial statements, but they're also responsible for making sure that we're following the plan documents, right? So whatever the plan says is, important that they're being followed, and so that will be a new precondition. Another precondition that we're going to have is when they're doing the 103A3C audit, again, relying on that third-party certification, they then have also management having to, if they elect that, would have to determine whether it's permissible. It's management's responsibility to determine whether the investment information is prepared and certified by a qualified institution. Right, so that's management's responsibility. That the certification meets the requirements in the Code of Federal Regulations, and the certified investment information is appropriately measured, presented, and disclosed within the financial reporting framework. So again, they've added some additional preconditions here that management has to take responsibility for, and we remind management that these are their responsibilities before we do the audit. Not at the end. These are not reps. This is upfront during engagement acceptance. Management must accept these items. In addition, for 103A3C audits, we should inquire of management about how management determines that the entity preparing and certifying the information is a qualified institution, because that is one of management's responsibilities. We need to get comfortable with the process that management used to make that determination. And then the Form 5500, right, we also need to obtain the agreement of management or those charged with governance to provide the auditor prior to dating our report with that draft that is, here's the key term, substantially complete, right? We don't want a draft that they're still making material changes to when we're doing our review for material inconsistencies or material misstatement of fact. So those are some of the additional items in AUC 210 that happen during client acceptance or continuance that we would want to be paying attention to when performing these types of audits. Then risk assessment, so AUC 315 as well as tax status. We have some requirements here. So AUC 315 is understanding the entity and its environment and assessing the risk of material misstatement, addresses the auditor's responsibility to identify and assess the risk of material misstatement through understanding the entity and its environment, including internal control. Well, one thing that they tell us here is that the plan instrument is basically the ruler of the land in an EBP. Right? The plan instrument tells us what we're supposed to do. And so as a result, the plan instrument is essential to understanding the plan and identifying performing audit procedures that are responsive. So we need to obtain and read the most current plan instrument. So again, that's why the management's responsible for being able to maintain that information, including any effective amendments as part of its understanding of the entity in order to do our risk assessment procedures under AUC Section 315. And in AUC 330, we respond to the risks identified by designing and performing audit procedures that are responsive. We would also want to consider, again, those relevant plan provisions that might have an impact on our risk of material misstatement at the assertion level for transactions, account balances, and disclosures. So you'll see here that risk assessment now basically requires that before you go out and do an audit, right? You always talk about if you fail to plan, you plan to fail. You have to understand the entity. And one of the biggest elements of a ERISA plan, of a 401k plan, is the plan document, right? So in order to know what your risks are, you need to know what that plan instrument says in order to be able to be responsive to those risks. In terms of tax status, as part of the auditor's responsibility under AUC 250, which is our requirements for laws and regulations, when we look at the plan's tax status, we should consider whether management has performed the relevant internal revenue code compliance tests, including the discrimination testing, and has corrected or intends to correct failure. So when we think about AUC 250, it looks at our requirements regarding laws and regulations. And so tax status is part of those laws and regulations. And one of the key elements here is that you have to comply with the Internal Revenue Code. And one of the key elements there is discrimination testing. So have they performed appropriate testing? Now let's talk about prohibited transactions. So we should evaluate whether prohibited transactions identified by management or identified as part of the audit have been reported in the ERISA required supplemental schedule. So if you remember earlier, we were talking about if things were materially misstated or if there was material inconsistency. One of the things it addressed was, well, what happens if management doesn't report a prohibited transaction with, in the supplemental schedule, and it gave us our instructions on how to handle that. But how would we know that? Well, we have to do procedures to evaluate whether they identified by management or if we identified them during the audit are appropriately reported in those supplemental schedules. If they become aware, if the auditor becomes aware that the plan has entered into prohibited transactions with a party in interest and the prohibited transaction has not been properly reported, then we need to obviously start with management. And if they do not revise it, then we discuss it with those charged with governance. If the ERISA supplemental schedule is still not revised, we should then modify our opinion when the transaction is material based on the financial statement as a whole. So again, using the materiality of the financial statements, if they are not including the information that we need here, then we should consider to modify our plan if it's material. When it's not material, then they're going to ask us to include an other matter paragraph describing the prohibited transaction. So even though it's not material to the financial statements as a whole, if we are aware of the prohibited transactions, they are asking for an other matter paragraph to alert people to the fact that it's missing, even if it's not material. If a material prohibited party and interest transaction that is not disclosed is also a related party transaction, that is not disclosed in the financial statements as well, because remember, related party disclosures are still relevant, even though it's a planned financial statement. They still have to follow the requirements for disclosures related to related parties. Then we're going to modify the opinion on the financial statements under AUC Section 705 because they did not follow GAAP. All right. So let's keep moving along here. I know this is a lot of information. This took a lot of time to come about. The DOL was, again, very active in this area, and they had, they wanted to address some of the confusion, some of the deficiencies that they saw as part of their overall monitoring process, because obviously they wanted to ensure that people are, this is somebody's retirement, right? So we want them to be able to retire. We want their money to be in a plan that's following the laws and regulations. And so the DOL was very much a part of this, making sure that we had these additional items added as part of this process. So let's think about in terms of evaluation and documentation. When the audit work performed results in the identification of items that are not in accordance with the criteria specified, for example, they don't follow the plan instrument, we need to evaluate whether these matters are reportable findings. And so this is something that's defined in the standard here. So what are reportable findings? Reportable findings are matters that are one or more of the following. So the first one, A, an identified instance of noncompliance or suspected noncompliance with laws and regulations in accordance with AUC 250. Right? So one of the things that we're required to do in AUC 250 is to identify laws and regulations that are material to the financial statements and have a direct and material impact, and identify what impact that noncompliance could have. Right? So that would be a reportable finding. A finding arising from the audit that in the auditor's professional judgment, so again, we're going to use that professional skepticism and our professional judgment, that's why they're paying us to do an audit, is that education and judgment. There is significant and relevant to those charged with governance for their responsibility to oversee the financial reporting process under AUC Section 260. So something that we would want is so significant that we would want those charged with governance to be aware so that they can do their oversight responsibilities. Or an indication of a deficiency in internal control identified during the audit that have not been communicated to management by other parties and that in the auditor's professional judgment are of sufficient importance to merit attention in accordance with AUC 265, communicating internal control related matters, right? So think of those significant deficiencies, material weaknesses that have not been communicated to management by other parties that the auditor believes requires that communication. All of these are examples of reportable findings. So when you are doing your audit work and you identify something that's not in accordance with the criteria, so for example, the plan instrument, you need to evaluate whether they should be reported under this reportable findings definition. If you are going through this, the auditor should prepare audit documentation in accordance with AUC 230, which is our audit documentation standard. If the auditor has determined that it is not necessary to test any relevant plan provisions under paragraph 20, then we would want that documentation as well. So you'll notice here that there was a real focus on the plan instrument, and that was very important because a lot of times we're saying, well, the financial statement does reflect the actual transaction that happened, but the transaction was not a permitted transaction. And so as a result, you'll notice that this plan instrument is going to be a key element of our audits under SAS 136 AUC Section 703. All right, moving on to required communication. So we have reporting requirements already. So AUC 260 and 265, one talks about our plans, our timing, our findings. 265 covers our internal controls. Well, we should communicate in writing to those charged with governance on a timely basis any reportable findings from audit procedures that are related to matters included in paragraph 20. So again, going back to that reportable findings element. And they should be included in the required communication with those charged with governance under AUC 250, which is our laws and regulations, 260, which is our communication with those charged with governance, and 265, which is going to be our internal control findings, either in a separate section or placed in the communication as the auditor deems appropriate. So very important that if we have these items, that we are communicating them appropriately. So we need to include in that written communication a description of the reportable finding, sufficient information to enable those charged with governance and management to understand the context of the communication, an explanation of the potential effects of the reportable findings on the financial statements or to the plan. So if you were following this standard when it came out in exposure draft, they actually wanted to put some of this in the report. They were trying to get this information about these reportable findings, and they kind of backed off of that, but they do require it in that written communication so that people can do something about them, right? So a description of the reportable finding, enough information in terms of context, and what is the impact? I always say the potential effects are the so what, right? Why are you telling me about this? Right? Why do why is this such a big deal? What impact can it have? What is, what's the, potential problem here? So very similar to, many people call this like the yellow book concept. Yellow book requires that when you write a finding, it has to have certain elements. You have to have a criteria, you have to have the condition, you have to have perspective, right? So you have all these requirements that are in yellow book for governments. This is very similar concept. They're giving us information about how we could best include and what to include when we write that written communication. The auditor should not issue a written communication stating that there were no reportable findings, right? So sometimes people even ask that for internal controls. Can you state that there were no significant deficiencies or no internal control deficiencies? And we're going to tell them no. We don't issue a report stating that we didn't find anything, right? So it's reasonable assurance. So we do not make those statements in writing. All right. Remember, this was an area, limited scope audits, now known as 103A3C audits, were one of the key areas related to findings. And so they are going to provide us with some explicit procedures that need to be performed when performing these audits under ERISA Section 103A3C. So first off, we need to evaluate management's assessment of whether the entity issuing the certification is a qualified institution. So you were probably wondering before where it said inquire of management. Most of us know that inquiry alone is never enough, and that's not enough, right? So now we need to evaluate management's assessment. If we, as a result of those procedures, we have concerns about whether the entity who is certifying it is a qualified institution, we should obviously talk to management. If management does not provide sufficient information that supports its termination, then we should go to those charged with governance regarding the implications for the audit. In our certification procedures, right, in our documentation and our procedures, we should identify which investment information is certified, right? So not all information is certified, so we want to make sure identify what is being certified. And then on that certified information, even though it's coming over as certified investment information, we're still going to do some procedures on it. So we're going to obtain that certification information from management. We're going to read the certification as it relates to the investment information. We're going to compare the certified information with the related information in the financial statements and supplemental schedules, right? So we're not just going to, just assume that they tie. We're going to do a comparison. And then we're going to read the disclosures related to the certified investment information to assess whether they are in accordance with the presentation and disclosure requirements of the financial reporting framework. All right, so we are not going to just take these certifications and say, oh, we're not giving an opinion, we're just relying on the qualifying institution. We are going to do some basic reading to make sure that they're disclosed properly, and we're going to do comparisons to make sure that they tick and tie. If, as part of our procedures, we become aware that the certified investment information is either incomplete, inaccurate, or in some other way unsatisfactory, right, we start with management and then perform procedures to figure out what to do next. In addition, we should perform audit procedures on the financial statement information, including the disclosures of anything not covered by the certification, as well as non-investment related information based on the assessed risk and material in the statement. So that is why this is not a scope limitation. That's why it's not deemed to be a qualified opinion or a disclaimer of opinion. We do want to be paying attention to the financial statement information and disclosures and making sure that we are performing appropriate procedures. Remember, sometimes plans hold investments in which only a portion are covered by a certification. In that scenario, any items that are not certified, we must perform full audit procedures on that investment information, which is why in step 1, we need to identify which investment information is certified, because not always is all of the investments covered by the certification. So that's always step 1. And then if it's only a portion, we need to do full procedures on the remaining. For all audits of ERISA plan financial statements, including an ERISA 103A3C audit, we are going to perform the procedures necessary to become satisfied that received and disbursed amounts, for example, employer or employee contributions and benefit payments reported by the trustee or custodians were determined in accordance with the plan provisions. So going back to that plan instrument, we are going to verify, regardless of what type of audit we're doing, if we're doing a 103A3C audit or not, we are going to perform procedures regarding the received and disbursed amounts and make sure that they're in accordance with plan provisions. Some people would argue that that's really a compliance test. It is a compliance test, but it's a required audit procedure as part of our financial statement audit. So that is something that they have added in this scenario. Can't have an audit without having some additional written representations. So we do want to review these additional written reps. So in addition to AUC 580, which covers the standard representations, we are going to request additional written reps from management when we're doing an ERISA audit. So first, that management has provided the auditor with the most current plan instrument, including all plan amendments, right? Because we are using that plan instrument to really use that is going to drive our risk and material misstatement. It's going to drive the audit procedures that we are performing. We're also going to have management acknowledge its responsibility for administering the plan and determining the plan's transactions are presented and disclosed in the ERISA plan financial statements in conformity with the plan's provisions, including maintaining sufficient records with respect to each of the participants to determine the benefits due or which may become due to such participants. So thinking about that, one of the things I really like is this is very similar language to what we're writing in the actual report. So we're being pretty consistent. We have it at the precondition of an audit. We have it in the audit report. We have it in the rep, right? So a lot of consistency in terms of what is management's responsibility. You're going to see that pretty consistently throughout here. If it's a 103A3C, we are going to have another written rep here acknowledging that management's election does not affect its responsibility for the financial statement. So just like we added in the reporting section where we say you still are responsible for these financial statements, we're going to have that in a written rep. And then you're going to notice here we're going to have a requirement that that management has determined whether that they can actually do a 103A3C audit, right? Whether it's permissible. That's management's election there. The investment information is prepared and certified by a qualified institution, that the certification meets the requirements, and the certified investment information is appropriately measured, presented, and disclosed in accordance with the applicable financial reporting framework. So as you can see here, we've beefed up these written reps in order to be responsive to the changes to not only the report, but the procedures that we have to perform. All right, so I know that was a ton of information. We've been waiting for this for some time. When we got the original exposure draft, there was a lot in there that doesn't end up in this final version, and there are some major changes between the proposal and the final version, so we wanted to make sure we spent time talking about where some of this information has come from. So again, we've covered all of the different ways of reporting, right? We covered the ERISA plan audits, formerly known as full scope audits. We covered the 103A3C report, which is formerly known as the limited scope audit. And then we covered the additional procedures that we would need to perform in order to be compliant with the new ERISA requirements there. So we're not going to be disclaiming an opinion, and because of that, they wanted to make sure that we had all those additional procedures there. So I know it was a lot. Again, I hope that it was helpful in you understanding. All right, thank you guys so much. Again, my name is Melissa Galasso. It was a pleasure having you on today's webinar, and I hope to see you on a future webinar. Have a great day, guys. Bye-bye.